So in this simple merger situation, what are the results? Borderline dilutive, 50% equity, 50% debt, 25% purchase premium. Here are the four major adjustments: synergies, amortization of intangible assets, quite standard, new debt interest, new shares, right? New debt interest from raising debt to fund the acquisition, new shares from raising shares to fund the acquisition. Here we have a sensitivity that we've built. We've done sensitivities on DCF. Yes, we've done sensitivities on DCF. We'll do more in LBOs. And we'll do cases and stuff. We'll get more technical with the LBOs. What is this saying? So first of all, variables across the row here. This is percentage debt equity. So this is 0% debt, 50% equity, 100% equity. As we go down the column, we're increasing the purchase price. As you increase the purchase price, should the acquisition become more or less dilutive? Why? Paying more, which leads to what? Taking out more debt, which means what for EPS? Because there is more interest. And then what else is causing the dilution? Taking out more equity, raising more shares, more dilutive. What happens if you shift from debt to equity? Should it be more or less dilutive? David? It does. Generally speaking, though. Yeah, right? Equity should be more dilutive, but it depends. You're exactly right. Equity should be more dilutive. Why? We went through this in the very, very beginning of M&A, almost still in the financial modeling course when we did equity raising versus debt raising. What's the difference? Yes, David. Yeah. Right. Yep. And what about that? So right. So with equity, there's dilution based on the shares being issued versus the debt, which is based on the interest cost of the net income, right? So when raising debt, the dilution is based on the interest cost reducing the net income versus when raising equity, it's the dilution of the shares. Why is it so that the dilution on the shares typically should have a greater effect than the interest, which I think, David, you were going, but I just wanted to reiterate. Uh-huh. Right. Right. Yeah, and why is that? What's driving that, George?
Is it earnings yield? Like if you want to compare
yes.
Versus some equivalent measure for equity?
Yes, that's a metric to determine that. That's an indicator of that. And why is that the case, Matt? Because of the riskiness of the equity and the risk, but the riskiness is almost subjective. I mean, there's technical factors that drive the riskiness of the equity. How is that translated into this model? Higher returns based on what? And what's that technical driver? Real simple. Maybe overthinking it. Growth expectations, and that impacts what? The stock price, right? The stock price is determined. And what determines the stock price? Or who? The investors, right? They're pricing in the impact of risk. They're pricing in the impact of growth expectations. So the investors should be pricing the stock such that if equity was going to be issued, it would have a greater impact to EPS. That's why raising equity should be more costly than raising debt. Costly to the company, right? Costly to the company meaning you're raising more of a portion of you're giving out more of a portion of the equity of the business, so that it's an added benefit to the investor versus debt. Otherwise, equity isn't more attractive than debt, right? They need equity to be more attractive to the investor. So in order for equity to be more attractive to the investor, it needs to come with greater return. Greater return is distributed here by issuing out more shares. So to the company, it becomes more costly. And that means that way to the company, it needs to be more dilutive. In this example, it's not the case though. Why? Why is it not the case that raising equity is more dilutive? It's actually accretive. It should be the case theoretically, but as David mentioned before, not always. Why in this case? What's changed? What are the two variables, George? It's going to be based on that. But what's the right? But why? You're right. I mean, you're hitting on the right indicators, but I just kind of want to explain why. So, what variable could have changed? Right. Right now, we're saying, well, the cost of interest could be 4%, could be 8%. Should typically be less than the cost of equity. Right. The cost of equity has to be greater to give the investor an incentive to take on more risk. Otherwise, they'll just invest in debt, which is more secure, and get their safe 4 or 8%. If the return to the investor has to be higher by investing in equity, and that's satisfied by a higher cost of equity commensurate with the risk that the investor takes on. In this case, opposite's happening. It's actually accretive to the company. The company is making money on raising equity. Why? What's the determining factor? It could either be that the interest rate is so high, like 20%, that suddenly interest is more dilutive than raising equity. Or what's the other variable, David? Stock price. Yeah. The stock price. Stock price could be what? So high that the cost is now pushed onto the investor. The investor is bearing the cost. In other words, if a company needs to raise $1 billion, and in a normal environment they have to raise 1 billion shares, $1 a share, right? $1 share. If the stock price was significantly higher, then the company doesn't need to raise as many shares to meet its funding needs. It can raise that large equity without giving out as much of the pie. Why is that happening? This happened a lot this is happening with IPOs today. It's an example. Etsy, right? They were a poorly priced IPO. It's been down 50%. For example, right? If a company is highly valued, the recommendation is always to go out and issue shares because people are paying an exorbitantly high price for the stock. But why is that happening? And what's the impact? Right, so you think about 99-2000, which is kind of what this was, 99-2000, where there was a lot of companies that were very highly valued and they're just going out issuing equity. Why are they issuing equity? Because investors were paying. Yeah, David. Yes. It implies, yes, so good question. So the implication is that the company is overvalued. And so theoretically, that value should come down. But if investors keep paying for that price, they are perpetuating this high valuation. So this is the debate. So the debate in 99-2000 is, are these companies now overvalued or is this a new market paradigm? Why are investors going out and paying such a high price for this money? Higher than what it's worth when compared to the security of raising debt. And the articles came out saying, CAPM is wrong, right? CAPM says, no, if you're paying a lot of money for equity, there should be risk return associated with that. That would make equity more dilutive. Not happening anymore. This is a time when E-Trade and Ameritrade, right, ways for anybody just to put your, send it online, put down your credit card, you can start trading within 24 hours. It was never like that before, And so what happened? So in this situation, this was, there were companies with almost very little or no fixed assets acquiring businesses with a lot of solid assets, like America Online acquiring Time Warner. That's what this is trying to simulate. And what happened? American Online bought this company with billions and billions of fixed assets in equity. They raised all equity, and it was accretive. It was a stock swap. And so at that time, a lot of articles came out saying this is the greatest deal, and this is going against the theory of CAPM. CAPM doesn't work anymore. CAPM's a failed model in this new environment when anybody can go online and trade. And then the rebuttal to that is no, maybe CAPM is right, but there's maybe CAPM only works when there's what? What's the rationale breakthrough here? It only works under what condition? That's missing here. Anybody come up with that? Yeah, a rational investor. I'm breaking it down, right? But that's the point. Yeah, I mean, maybe too obvious, but that's the point. Only if the investor was really rational and saw this model that they're actually paying the company, right? They should be receiving more dilution, right? Then maybe these types of situations won't happen. Well, what's wrong with this situation? Investors were paying a very exorbitantly high price for a company that wasn't worth that much. At some points, the market corrected. There had to be a lot of asset write-downs, and then the merger turned into a mess and imploded. Why is that a problem for the investor? Because they overpaid, and then they lost a lot of money in the long run. If they had paid the right price to begin with, or not paid for this, effectively not allowed that merger to happen, the environment might have changed. So what determines valuation? You mentioned this before. What is one metric that determines valuation? One common metric. One multiple. PE, right? So this is hopefully trying to explain why PE is a good first indicator of the accretion or dilution of M&A. So let's look at the PEs of the business, okay? Of the business, the acquirer and target. So the acquirer had a price of $100 a share. I rounded and simplified these numbers. $100 per share. And their EPS, the acquirer EPS, was about $2. So that's 50 times PE. Very high. Target company was 70 over 2, so 35 times PE, maybe less. So the acquirer's PE was much higher than the target's PE. The acquired company is very overvalued. So the company was able to meet its funding needs to make this big acquisition by issuing a lot less shares than they probably would have needed to in a normal market environment. They gave away just a few shares and were able to buy this big company. Why was that happening? The investors kind of allowed that to happen. Why did they allow that to happen? They kept paying high prices, exorbitantly high prices. Why were they keep paying high prices? Who knows? Maybe there are a lot more new irrational investors in the market. We gave the example of E-Trade and Ameritrade. I don't know. But that was the mystery. And the argument to that was, that you read about in the papers, this is good. CAPM is wrong. Right? So now what happens, though, if the acquirer stock price was appropriately set? What if they were at a PE that was normal? Normal meaning around 15, 16, which is the average PE of the S&P 500. What would happen? We should see a normal environment where raising equity is more dilutive than raising debt. Right? And investors should have the tools to know this and understand this and say, well, listen, 50 times PE, I'm not paying that because I'm basically just making money for you. I'm making you more accretive when I should be paying a price that's commensurate with a normalized PE for you to make this acquisition. You need to give me more. So if this was, let's say, 30, if you change the acquired stock price to 30, that's a 30 divided by 2, it's a 15 times, it's a normal PE. Right? That's an acquirer company of a lesser PE, acquiring a target company of a greater PE, and then here you see more dilution. This is what you'd expect to see. This is expect to see a 100% equity case being more dilutive than the debt case. That makes a lot more sense. That's a rational acquisition, where raising equity is more dilutive to the business. So this should help explain why this only works in a 100% equity case. The PEs can help determine if the acquisition is going to be accretive or dilutive, because because you're raising equity based on the price to earnings per share. In a stock swap, it's an equity exchange. Notice these debt numbers didn't change at all. Whether the price was 50, whether the price was 10, this didn't change at all. What changed was the equity case. So this comes up a lot in interviews, right? When they're saying, well, they'll give you some metrics and they say, well, would this acquisition be accretive or dilutive? And they want you to calculate the PE and see if the acquired PE is greater than the target PE. But they might go into explaining why. Only in a 100% equity case does it work. And this is why. And this is also proving that if the investor was rational and was paying a normalized price, they'd see a situation where the 100% equity case is more dilutive, which is what you'd expect to see given the risk associated with equity. And they learned the downfall of taking on the risk with that equity, right? Market correction. America Online Time Warner imploded. They changed the management, they flipped it around, and it was a big mess. This is a good example of that. So, any questions? Yes, George.
So I'm just trying to summarize my words.
Oh, good. Yeah, please.
So does this mean that if you assume no synergies, one company is acquiring another, if they have the same PE, there's no accretion, zero?
Assuming it's 100% equity, assuming no synergies, and assuming no other impacts on adjustments outside of the transaction, be zero.
Well, what about if one company acquires another, same assumption, no synergies, but it's funded using 100% debt?
Then it depends on the interest of that debt, and then it depends on some other things. Equity has no play in that whatsoever. Share price has no play in that whatsoever. That's exactly the way to think about it. Any other questions on that? But it's a good summary, and this summarizes all the pieces to that. So based on that, what's impacting the accretion here? We said synergies. This is a stock swap, right? So you can look at the PEs to determine what the accretion dilution could be. We don't need it. We have it down here. How significant is the impact of synergies? Where are the synergies? They gave us a range of 400 to 600. Notice if you zero out the synergies, it becomes dilutive. Greatly dilutive. So they're really riding on the achievement of these synergies for the deal to become accretive. So that's one thing to be considerate of. That's a major driver. And we talked about synergies, about how difficult they are to realize and things like that. What else is impacting this merger? We talked about the impact of the target financials. Great, that's the first thing you want to think about. Talked about the synergies creating accretion. If the synergies are gone, what's diluting this? What's diluting this now? New shares issued. Big component. Stock swap. What else? Interest rate paid on new debt, but we have no new debt. But maybe, I think what we had done was we had taken on the target debt and used the acquirer interest rate. So there might be some, assuming that they refinanced, so there might be some pop in interest. Say again? Dividends, I don't think they're paying dividends, are they? Preferreds haven't changed from the acquirer. At least we didn't, maybe they are, we didn't model it. What else? So that wouldn't impact the EPS there. What else impacts that? New shares, interest, amortization we don't have, right? But that's one thing to consider, but we don't have that. We took that out. Or they're paying a discount to book value. What else would you look at? Another thing to look at is, in a full-scale model, are the balance sheet implications, right? What's the impact to book value? Book value is increased. That's a benefit. That's what a lot of investors look for. Here's an analysis called an earnings contribution analysis you'd usually see in a stock swap. I was really simple with this, but this just shows what percentage of revenue, EBITDA and EBIT came from one company versus the other. Who's the dominant party, right? Would Office Depot contribute 89% and then Office Max 11, right? In this case, it is almost very much a merger of equals. They are very much putting in equal amount. Office Depot is clearly dominant by 18, 19%, but it's not so massively dominant. Remember, in the very beginning, we gave the framework of all types of mergers that are out there. But this is one way to look at it. And you're just taking revenue of one and the other divided by the whole, right? You're just weighting it. This is another way of looking at it. So the important takeaways here and why I showed you that mini model is to not get caught up in all the, so it's important, number one, from a technical perspective, to learn how to build all the pieces of the model, right? Obviously, that's the first and foremost, that's what you got to get done. And I know there's some repetition, but I need to go through it completely just to check the box. Two, where I really stressed in the early weeks, is important while you're putting this together to not get lost in the line items and understand how to step back and high level think about what's really going on. And it comes down first and foremost to EPS. And most importantly, what's driving EPS and why? So that's kind of really what the takeaway is supposed to be. And it's all based on those four drivers of transaction adjustments, either in a balance sheet or income statement perspective. And the idea that you're literally adding together the financials, except for items dealing with target equity, debt and target equity, assuming you're paying off the debt, assuming you're paying off the equity. That's the takeaway. So, a lot of times I've seen this being taught where it's just sell to this, sell to this, sell to this, sell to this, and you're not left with really understanding stepping back and what the process is. And great doing it that way to be productive on the job to learn a template, but for interviews and things like that, you got to understand the subjective side. So that's what I hope you've gotten out of it. And interesting to note that Synergies is the one driver. I've rarely seen, I've seen M&A models where Synergies were the core driver, and you take out the Synergies and it's still accretive, but in this case, take out Synergies, it's dilutive. So they're really riding on Synergies. And it's important, finally, to note, I pulled up the S4, and based on various sensitivities, anywhere from 58 to 77%, that's kind of what we had gotten to, I hope. Where'd the model go? Yeah, 58. 58 is kind of right in that range. 66, 86, 77, maybe in the dilutive we're a little bit higher. 66 is kind of a little bit higher than the management. It depends on the sensitivities. I didn't back into their management numbers. They tend to be a little bit more aggressive. But we'll look at this stuff when we look at Hines for the LBO. Because in Hines, we're actually making projections. In the M&A, we're not actually making projections. We're dependent on the core company's projections, which I use to match the street. I didn't use to match management. So there might be a little bit of a difference there. With all the other components, it should be pretty close. Any question on this? Yes? I would. Yeah. I mean, I actually wonder. I haven't followed up on it. I wonder what happened. I'd call it risky if you don't know how sure they are about the synergy. So they actually didn't say, I mean, having synergies of 0 is very conservative. They actually said, and they kept touting, between 400 and 600 million. So if it was 400 million in synergies, then what would the accretion be? Let's look at that. I mean, how sure are they're going to achieve those 400 million in synergies? I'm generally bearish on the achievement of synergies. Although in a situation like this where the companies are so alike, maybe it is more the chance that they'll actually achieve those synergies are higher than companies that are completely unrelated. So you tend to think maybe they do have kind of a reason behind that, consolidating stores, branding, and things like that. So I didn't look at it into that detail, but generally, so it's still highly accretive at their bottom of their synergy estimation. So it really does absolutely come down to how sure are they that they're going to achieve those synergies, and really it's the time frame to that. I didn't dig into that though. That's a tough thing to dig into just with public information. But good point. George, yeah.
I'm just trying to kind of understand, all else equal, if there's a way for us to determine when equity is more expensive than debt. Obviously, it has to do with interest rates and PE ratios and stuff, but is it a good way of approaching that, or should I go through it?
You can, well, a trick is you can take the reciprocal of the PE.
Right, so it's earnings yield.
Yeah, so the earnings yield, like you mentioned before, and compare that to the interest rate. That is a generally rough estimation. So if you have a debt that has 5%, this is actually a banking question. I was going to ask you guys this. I have a whole bunch of questions. But if you have debt that's 5%, and then you have a PE of 10, what's more costly? Right, well, if the PE is 10, you take the reciprocal, 1 divided by 10 is 10%. That's the rough estimation of the return on equity. The reciprocal of the PE, it's the EP. I don't know if that was your question, but that's a quick way to look at it. Okay, good. Yes, James.
Obviously, you just said that. So then your P ratio is normalized, meaning that the company is, meaning that the acquired paying for, so the amount the company pays for each dollar of earning is roughly equal to how much the market value is earning.
That's determined by the market.
Okay. You mean like the industry's P ratio, or you mean?
Okay, so I want to begin talking about leveraged buyouts. And this will look similar to the structure of what we did with M&A, about 3.5 weeks. I'm going to focus on the soft, kind of on the board to give you the concepts. That's going to be more what you will see in an interview. And assuming that you're going to have LBO models, most of you on your resume, be prepared for something like this. So everything from just kind of talk me through an LBO to, they give you a couple of things like EBITDA, how do you do a full LBO on paper, to just kind of one-off questions, and I'll focus more on those one-off questions. We didn't do a lot of one-off M&A questions too, so we'll kind of do that in the mornings, right, morning prep. All leading up to an LBO model case that's going to have a little bit more complexity, right? We'll have more layers of debt. We're going to design a capping revolver. We're going to look at the acquisition of Heinz. That was an LBO by 3G, which is a private equity firm, and Warren Buffett. We'll look at the benefits of it, the weaknesses, what made it an LBO, did it not make an LBO. Warren Buffett had a different type of investment in there where he had a preferred security. We'll model out paid in kinds. We'll do amortization and capitalization of debt fees. We'll do a lot more kind of technical stuff just to kind of complete, I think, what you need to know for modeling. And then we'll have some case studies. Again, final round case studies that I've gotten, but these are model case studies. I won't grade you on them, but we'll do them together. So that's what we're gonna look at. So before getting into the case, I want to get into kind of the first piece here, which is what an LBO is. So what is a leveraged buyout to you guys?
So it's an acquisition of a target company and significant amount of more capital to meet the cost of acquisition.
Yes. Why is that funny? It's right there. But I didn't. I trusted him. He was saying it word for word. No. But yeah, good job. No. Yeah, it's an acquisition using a significant amount of borrowed money to meet the cost of the acquisition. That was my fault. I shouldn't have put this on it. But what does that mean? I mean, so this is really under the hub of M&A, right? This is under the hub of restructuring, right? You're restructuring the balance sheet, but the biggest difference is it is a significant amount. What do you mean by significant amount of debt? A lot, but 6 times what? It depends. Well, it depends on the EBITDA of the business, right? But usually, let's say 30% of the sources is equity. I've seen some deals with 50% equity, just in rougher markets, and I've seen deals with 10, 15, 25% equity. The rest is debt. So it's the amount of debt, and what else? What else is a key driver? Not just the amount. How do you get that debt? Interest expense. What else? It's not just the amount of debt. Yeah, the credit rating is a big determinant. Yeah, David. Say it again. How it's collateralized. The type of debt, right? So there are different levels of debts, which is key, right? You are pursuing more aggressive types of debt above and beyond the standard bank debt in order to maximize the type of debt that you can raise in order to acquire the business using a significant amount of debt, right? So one thing to note is the debt is backed by the assets of the business you're acquiring. It's a big determinant. Matt, do you have a question? No.
Yeah,
Okay. So I like to think of, I like to compare this to like a mortgage loosely on a house, right? A mortgage on a house. So let's say if you were to invest in a house and you were to take out a mortgage, which is backed against the assets of what you're paying, you can buy a bigger house for less capital commitment. That's the benefit, right? And so what are the benefits of an LBO? How do you find value in an LBO? If you were to acquire a business and use a significant amount of debt to fund this business, what's the driver? What's the driving reason for that? What are you looking to do? Debt pay down for what purpose? Increasing returns. So you want to maximize your returns. If you're putting in 15, 20% equity, you want to maximize those returns. How are those returns maximized? Yeah, the less equity you put in, you would hope that, how do you maximize? Christoph. Selling it for a higher price. And what else, David?
Now, understanding a much larger portion, and so the less equity you have, the greater that return by the other.
Yeah, that's right. So leverage. I thought I swapped these slides out, but okay. So we'll go through those other slides, tomorrow. So there's a couple ways where you're really converting the equity that you put in to maximize value, and there's 2 general theories. Well, there's actually 3, right? One is the organic growth theory, right? The idea that you're improving the business, you're improving the operations. If you improve the operations, you're improving EBITDA. If you're improving EBITDA, you're improving net income. If you're improving net income, you're improving retained earnings. Net income goes into retained earnings, increasing equity. And this I don't really care for looking at it this way anymore, but I guess just since it's up. Let's assume this is the book value of the business, right? You look at you always, when you're modeling in an acquisition, even if it's an LBO, you want to look at the book value of the shareholders' equity for purposes of goodwill and everything that we spoke about in M&A. So let's say that the company has a book value of 4, they already have 6 in debt on the business, total assets of 10. We want to do an LBO, right? We want to buy out the business. Market value, it trades at a premium. If the company trades at a premium in market value, let's say 14, quite a significant premium, and let's assume that we're adding debt of 6 to the business, that's the same debt. Let's assume that's just the book value of debt, forget the market value of debt for now, so that's the incremental difference. What's this part represent? Spoke with this in valuation. What's this assets 20? What's a way of looking at that? Taking the market value and adding back the debt. Enterprise value. Or it's the implied value of the assets of the business as determined by the investor, more or less. I mean, you want to look at net debt. So let's say you want to purchase, you typically want to pay a premium above market, but let's say we paid at market. We paid at market, and so the LBO is showing that we're putting in less equity, 5, because we were able to get 15 of debt. So the way an LBO works is you're able to get, how are you able to get such a high amount of debt versus the way the company was operating before? How does that happen? It's a couple things. A couple of reasons of which make an LBO work. Yes, Connor.
You can take on more debt because you're able to pay down the interest with capital.
You're able to pay down the interest and cash flows, but why couldn't you do that before? So you're right.
The debt market is very cheap at that particular point.
Maybe the debt markets are cheap, George?
You take on more higher yielding debt or higher, more expensive debt.
You're taking on, and then why is that working all of a sudden? 2 important aspects. What started at LBOs? Matt. Lower interest rates started at LBOs? It could. Junk bonds. Right? Junk bonds in the 80s. Actually, there were LBOs in the 70s too. So junk bonds in the 70s, but it became real popularized in the 80s. Right? Michael Milken and all that stuff. So what is that? How does that give you a clue to the feasibility of leveraged buyouts?
So PE firms can issue a lot of junk bonds to raise larger debt.
So access to very aggressive debt markets is one aspect of doability in a leveraged buyout. What else? Another important key that a lot of people overlook. It almost goes hand in hand. It almost allows access to these debt markets. Yes, David. What were you going to say? Stable, steady cash flows. That's a key driving element. What Connor mentioned too. But what's allowing this to happen? Can you come up with that?
What is allowing what?
The ability to take on so much debt where you couldn't prior. They're backed by the assets. You're tapping into more aggressive types of debts. Yes. What else? One other key aspect leading to the functionality of this. Yeah, they have access to all these debts. And what else? Why? Why can they do that though? I mean, you're all in the same area. How are they promising bigger returns? We'll look at this when we look at Heinz, right? Heinz is now back in the market, right?
Is it a timing thing?
It's a timing thing, and Matt? There's different levels, which is kind of what I assumed as part of your answer with the junk bonds, getting into those different levels. They could have it, but why couldn't they get into these? Why can't just any company get into these levels of debts? Only certain types of companies can do it. Say again? Private companies, yeah. Yeah, the company is getting into aggressive types of debts that public markets would never allow, right? If there was a public, so let's say if Heinz was not bought out, but if Heinz said, we're going to go and lever our balance sheet up to 75%, people are going to go nuts, right? They're going to sell the shares and go crazy, right? Put this company in arguably an unhealthy position, take on all these high-risk bonds and things like that. Only when the company is private can you get into these different tiers of debts and put in less equity and then restructure, right? So two very important aspects is you're taking the company private and you have access to debts. These are two things that allowed these big leveraged buyouts in the late 70s to happen, right? The ability to take the company private and the advent of all these more aggressive types of lending. Yes, high yield, more expensive, which is what Connor and David was saying. Well, maybe the right company would have high and steady cash flows to pay down those debts. So let's say, going back to this mortgage example, let's actually say, let's say we all put our money in and we want to buy a building in Manhattan. So you buy a building in Manhattan, right? We're gonna lever it up. It's backed against the assets. Let's say we're able to get a lot of debt backed against the assets. It's private anyway, who cares? Put in 10% equity. How are we gonna, there are three ways that we would extract value in this apartment that you can relate to value in the business. One, organic growth, right? We believe that we can improve the building, we can make CapEx improvements, we can improve the net income of the business, right? That would improve the value later. We can sell it for a higher price because we are making capital improvements, right? That's organic growth. The company's growing. Two, financial engineering has a negative connotation these days, but this is the cash being paid down the debt. The cash paying down the debt, you guys have been saying. The cash produced by the business will pay down the debt over time. Let's say we got the building's fully occupied. We want the building to be fully occupied. We want renters in there. The cash being produced from the business will slowly, year after year, make our mortgage payments and pay down our mortgage. By the end of, let's say, 30 years, our mortgage would have been paid down, and we've effectively converted all that debt into equity. That's two. Cash debt pay down. That's the second strategy. Three, the third strategy is called multiple expansion. The idea of multiple expansion is the idea that you can sell the company for a higher multiple than what you bought it for. What determines the multiples? See? The market. So the example I give for a multiple expansion is, let's just say the housing market or the apartment building market in New York is bound to increase in 10 or 15 years. So just because values are increasing, even if we don't do anything else, we'd hope that we can sell the building for a higher price than what we paid for it because the value of the markets are increasing. In business, how to determine value of markets? Multiples. Multiple expansion. So in a business, there are three core drivers to, if you were to invest in a business, to trying to extract value and increase returns. One, operation improvements. Right? The idea of operation improvements leading to organic growth is the fact that you can improve EBITDA, maybe new marketing initiatives, cost cutting, anything to improve EBITDA, which will improve net income, which will improve shareholders' equity. Two, cash debt pay down. You want to find ways to increase the cash in the business where you would hope that the company has strong and steady cash flows that will go to paying down the debt. You pay down the debt over time, you're converting debt into equity. Third is multiple expansion. You'd hope that you can sell the business, even if EBITDA doesn't improve. You can sell the business for a greater multiple just because markets are improving. So those are our three driving strategies. And it's important just to loosely start to think about those, because when you're doing an LBO, there's two sides to it, like any case study, right? There's the technical side, and there's, okay, well, what does this mean? So a lot of times I was in final round private equity interviews where either they ask you to build the model, or more commonly, you look at a bad LBO and they say, well, well, what's wrong with this? And this is to determine the guys that know how to build the model from the guys that actually know how to use and interpret the model. It's one thing you know how to build it mechanically, put together a template. It's one thing to say, okay, well, what's wrong with it? What are the drivers? So start there. Start with the 3 drivers of growth. And we'll reiterate that. I had better slides. I thought I swapped them out. Maybe I pulled up an old presentation, but we'll go through the slides also. Those are the 3 core drivers. I'll let that sink in, and we'll dig into the mechanics. But so, what makes a good LBO then? What types of companies make a good LBO target? How would you guess that based on what we discussed? Yes.
Great cash flow, something that will also go low capex, maybe good assets.
Companies that have high and steady cash flows, right? Predictable cash flows. It's important, not cash flow swings. What else did you say? That was the same thing.
Goes, like low capex, which goes again to cash flow.
Anything that relates to good management. A good company. Well, what do you mean by a good company?
Well, the management that basically sets the goals to produce those cash.
It depends. I mean, a lot of times you're looking for this is a turnaround strategy, right? So a lot of times you're looking for, cutting costs in management or management inefficiencies that you'd seek to improve. So it depends on that. It's kind of a double-edged sword there. What else?
So the company has strong asset base.
Strong asset base, right? To be able to lend debt against. What else? What are other aspects of good? Yeah.
Viable exit strategies.
But yeah, you definitely have to have a good exit strategy. So maybe companies that are undervalued. Right? What? Yes, Abhinav.
Lack of debt.
No debt. Lack of debt. Yeah, companies that have very little debt. Tough to do an LBO on a business that's already levered up. You can't take out additional leverage. Very important about that. What are typical exit strategies of business? So very important point. You got to make sure you have an exit strategy. What are typical exit strategies? Abhinav. Oh, sorry. Management buyout, right? Sell the company back out to the management. Selling it to a strategic acquisition. Cameron. IPO. Going public. Elena? No? Anybody else? Maybe, yep. You can sell the assets of the business. You can sell it to a later stage private equity firm I've seen. You want to make sure you have an exit. Yes?
So you can just pay yourself dividends.
Dividend recapitalization. Yes. Anyone know what a dividend recap is? This was popular in 2009 when a lot of companies were planning to exit those businesses in 2009, and then the market crash happened. And so what do? They did a dividend recapitalization, which basically means it's almost like you're selling it to yourself. So let's say you buy the business in 99. 10 years later, in 2009, the company's cash paid down the debt. Right? It's delevered, it's ready to be sold. Poor markets, valuation down. You can sell the business at a loss, or you can re-lever up the company. Put 75% debt back on the business. You get a bunch of cash. What do you do with that cash? Pay management. You pay yourselves. So you're basically re-levering up, paying yourself, and then hold the company for another 10 years. Let it pay down again, and then hopefully the markets are better. Then you sell for an exit. Dividend recapitalization. We'll look at that later on. Big exit strategy. I got slides that lay that out, but let's look at that. Thought you had a question. All right. What are the core steps to a leveraged buyout analysis? Let's brush on the technicals, and we'll go back and dig deeper and deeper. So there are major steps to leveraged buyout analysis, very similar to an M&A analysis or any restructuring, right, or transaction. Number one, you got to get the purchase price. Real simple. How do you get the purchase price? Valuation. Number two, you want to look at the sources and uses of cash. And then we want to go through the pro forma adjustments in the analysis. So we'll look at that. And purchase price, very similar to the purchase price in a mini merger model or any acquisition. You want to just go through the valuation analysis, comps, prepaids, DCF, negotiations. A lot of these times the company is private. If it's not private, you are taking it private. So you have to consider that when learning how to deal with the net debt. What do I mean? Well, let's go to step two. How do I pay for it? Sources and uses. Uses determine what am I paying for. Uses are basically same three items. The purchase price, right? You are paying for the purchase price, buying out the owners. Possibly refinancing the existing debt and the transaction fees. What does refinancing the existing debt depend on? We talked about this a lot. Not necessarily. Whether it's private or public. How? If the company is public, what happens?
Has the obligation to actually pay
the acquirer has the obligation, right? Because you're buying out shareholders. You can't leave the shareholders with the debt. The acquirer has to maintain responsibility, right? So if the company is public, the company acquirer needs to maintain responsibility, and you have to look at the covenants of the debts to see if it is required to pay down those obligations. The covenants will determine if in a change of control scenario that the acquirer has to pay down those debts. If they have to pay down those debts, then you add them to the uses. Right? You're paying more than just the purchase price. You have to pay all the obligations. If you don't have to pay down those debts, maybe you can absorb those debts and bring them onto the balance sheet, just like what we did with Office Depot, Office Max. If the company's private, if you're buying a private business, who maintains obligation of the debt? It depends. It depends on what? It depends on your negotiations and what else? The multiple. Depends on valuations. From an analyst perspective, it depends on how you value it. And this is just a word of caution because a lot of time, often in valuation, you end up pricing a business based on enterprise value to EBITDA. So if you're buying a business based on a 7 times EBITDA multiple, and the business is $100,000, so you're paying $7 million for the business, that's an enterprise value, right? So if you've negotiated $7 million based on enterprise value, don't add the net debt to that, you're double counting. The enterprise value already includes the value of net debt. If you're negotiating with a private seller, $7 million, you're basically telling him this is the value of the business plus the net debt. I'm paying you for the net debt. You take care of the net debt. Make sure you think about that. Don't double count by pricing the business based on enterprise value and then adding net debt on top of that. Double counting. If you're pricing the business based on enterprise value, that includes net debt. That's the total uses of cash. Sources, where's the money coming from? A combination of debt, equity, and cash. And in an LBO, we have access to a lot more types of debts that we will model in the case study. So general, real kind of quick spectrum from lowest secure risk to highest risk. You always start by looking at bank debt, which is usually 30 to 50% of the overall sources. Another rule of thumb is 2.5 to 3.5 times EBITDA is usually raised in total debt. I haven't seen 6 times. That seems like a lot in total debt. That's what you guys have, huh? Okay. Seems like a lot. In total debt, though, right? So, let's see. Bank debt has initial rates on the assets, lowest risk, expected returns, 5 to 12%. That's the interest rate. Higher the interest rate, the higher the risk. Next, you go to the high yield markets. Junk bonds, kind of basically non-existent now. What happened to the junk bonds? What killed the junk bond market? That was interesting. Before asset-backed securities. Oh, that's an interesting piece of history. Nerdy history. That junk bonds existed after that, but that was a keynote leveraged buyout because of its use of junk bonds. The RJR and Nabisco acquisition by TH Lee. What else? What else killed junk bonds? What was the market? They're kind of coming back, right? But never not like it was before. So Let's see, what happened before 2009, asset-backed securities and things like that? Because that wasn't really junk bonds. It was junk, different kind of junk. That was corny. That was really corny what I just said. What else? What happened before that? What was the prior implosion, the prior crisis? .com? .com happened. .com still didn't kill the junk bond market. Even after junk bond, high yield funds everywhere. Everyone's leaving Morgan Stanley. All the analysts were leaving to go to high yield funds. And then they all got fired months later.
Was it after the dot-com?
After the .com. What happened? I don't know, you can think about it. What was another ripple effect after the .com implosion? Were you guys in high school at the time? No. Before that? Don't answer that, make Phil. What else happened? So again, no. Well, that was another problem. That was after that. I guess that started in 2007, or really started. That really actually started. The mortgage crisis started in the 90s. I mean, the packaging of those securities started. The building blocks were formed, maybe even before. Huh?
Was it in the U.S.?
Yes, good question. It was in the U.S. Not necessarily.
I think the federal
They cut the interest rates. Why? To stimulate the economy. That didn't kill the private junk bond market yet. They were trying to get it. And there is something else. Another big technological movement. Give me the technology. Kind of. I wasn't involved in it. I knew enough. Just by chance. Something else. Everyone has one. Cell phones. What about cell phones? Internet. Telecom. Where's telecom still exists, right? Kind of. That was the big industry. But what about telecom? Fiber optics. Kind of coming back, right? Kind of people didn't know if this was technology, was it power, was it energy, where did it go, right? Where it was its own industry, it was its own element, right? Everyone was getting cell phones. Back then, we had beepers. Huh? Wireless. But how did that conflict? So back then, there were high yield funds that raised billions of dollars to dig up this in Manhattan and all the cities, but this is good, to dig up the streets to put fiber optics under the ground. And Con Edison would own them. Verizon would own them, or I don't know. There was some partnership. I don't know that 100%. But I know, because we worked with Con Edison, so you're right, I did kind of do a little bit of that. These high yield funds, it was perfect. It was backed by an asset. It was backed by, everyone was going to use fiber optics, high-speed internet, right, through fiber optics, right, it was at the time, high-speed cable, right, you can have 1,000 channels, right, and it was asset-backed, and they would do high-yield lending, 25%, sometimes even 30% lending to these communication companies that would say, all right, well, in 5 years, everyone's going to sign up to these high fiber optic networks, and we'll pay you back, right? But what happened? Huh? Yeah, no one did. Why did no one do that? Wi-Fi. Wi-Fi came out. I don't know why no one predicted that. Wi-Fi came out. Cellular exploded. Satellites whoever started putting satellites up there overrode the necessity for fiber optic networks. It just exploded. So I think even 5 years later, there's a statistic that Con Edison said that of all the fiber optics that they built under the ground, only 10%, even today, are being used. Just 10%. So once there was the realization that these fiber optic wires and all would not be realized and they wouldn't get paid back, all those high yield companies imploded, and I don't think junk bonds ever really came back from that. I mean, it was disastrous, billions and billions of dollars, and it'll come back over time. So now that there's been a small resurgence, there's junk bonds in different forms. We'll talk about it. What's really popular are paid-in-kind securities. We'll model out paid-in-kind securities. Good to know. There are definitely still junk bonds out there, but not as the industry that it was. And that was the biggest, most secure. But what's interesting is I think arguably those fiber optic cables are probably the most secure, but Wi-Fi is just so much easier. He's more easily accessible. Well, interesting. So even though I say high yield, in the sense of any security that's higher interest and higher risk than bank debt, that exists. Not as aggressive as it was. You don't see these big straight up. Well, maybe are there any straight up high yield funds out there right now just doing high yield? There used to be tons. I think there's probably a handful. I don't know. Maybe not. I don't know who's going to be investing in that. Maybe they're diversifying. But that's they do. So when I say high yield, I mean anything that's a little bit higher interest, higher risk than a bank debt. That still exists more commonly now in paid-in-kind securities. Anyone know what a paid-in-kind security is? It is a type of debt, very costly, where you don't pay interest in cash, you pay interest by borrowing more money. So when interest comes due, raise more debt, interest on interest. You get rid of it upon exit. I don't think Walmart does that, no. Too aggressive for Walmart. So we'll model those out. Good to know, makes you look smart. People will ask you if you know about paid-in-kind securities. So we'll do those. Mezzanine, I mean convertible, I mean any combination between debt and equity, any hybrid. There are convertible market desks in investment banks that are designed to create any type of hybrid security to match an investor with somebody that needs this type of security. It is basically at its core debt that has some equity component that is convertible to equity after either a certain time or hurdles are made. And in LBO, it's beneficial because as an investor, you get the protection. You can say, all right, well, this is debt for the first 5, 6 years. Let me see how the company is doing. If the company does poorly, I have more rights than equity. If the company does well and takes off, then I convert to equity. Yeah, that's one example. Mezzanine. Higher risk, higher expected returns. The increase in expected returns is baked into the idea that this has an equity component to it. So we will model out mezzanine because the Heinz acquisition contained a type of mezzanine preferred security. We'll model out what the returns were based on that. And the rest is equity. Financial sponsors, no downside protection. That's the general spectrum. So the general spectrum is as vague as this looks. Some type of bank debt you always go for, some type of higher yield interest, even though it doesn't look like it used to, some type of convertible, and then straight up equity. George, yes.
Are mezzanine our preferred securities less senior than mezzanine?
It depends. So preferred securities is under the umbrella of mezzanine. It is convertible. Most every preferred at least come with warrants that is equity component. There are definitely a type of preferred security which is just a senior type of common stock. That's more equity. We'll do a whole thing on preferreds. They are more often considered mezzanine. Yeah.
So you're saying the mezzanine could either be subordinated debt or preferred security, right?
Mezzanine is never just straight debt. It is always a mix of debt and equity.
Well, for a company that's going private, how do you determine the exercise price for a convertible bond holder?
If you're creating the security or as an analyst modeling out the transaction?
As an analyst modeling out the transaction.
You might never get that. So a lot of times you do like an 80-20 rule. You assume 80% of it's debt, 20% is equity, or vice versa. A lot of times you just do that and make that a driver. We'll face that dilemma with Heinz. Any other questions? Okay. Debt valuation. Yes, we'll look at debt multiples. We'll get into more detail about debt multiples. Debt multiples are important in determining doability in terms of raising debt. There are several types of debt multiples. We'll look at them. Most commonly, debt to EBITDA. Right? Debt to EBITDA determines a lot of times these debt multiples are used by, let's say, S&Ps and Moody's to determine what your credit rating should be in relation to a lot of other factors. So if you're within this threshold, you should be AAA or AA. They're also used by banks and lenders to determine how much you can lend, right? If you're within this threshold, then we can lend you this amount. If you're above this threshold, it's too much. You can't meet the interest payments. So we'll break the debt multiples down into more categories. Any other questions? Okay, so let's take a quick kind of subjective example of what happens when we buy a business. So let's say we've come up, I'm just going to use a word, right? We've come up with a purchase price for a company that we want to buy. And we've come up with uses, right? Which is paying the purchase price. We have to support the target company's net debt and fees. And then sources, which is a combination of debt and equity. Right? Now what happens? Right? We build the model, or we don't build the model, we're just given some numbers, and we say, all right, well, I want to know, if I invest in this business, what's going to be my return in 5 years? Right? Well, the first thing I do is I need to know, I'll just keep it as brief for now. I need to know at what price will I exit the business. I need to sell the business. So I have an A to get there. So first, I need to calculate my exit. My exit is my year 5 EBITDA times multiple. What multiple do I use? What multiple would I get? How would I get that multiple? Do you guys know? Any idea where I'd get the multiple? No idea? You could do P-page, you could do comps. Conservatively, yeah, you use the purchase multiple. Conservatively, you assume no multiple expansion. Right? If you were to sell the company at the same multiple that you paid for it, you'd hope that you at least receive a return because EBITDA is growing. That's the idea. So oftentimes in the beginning, you use the same multiple as the purchase multiple. So you take the purchase price plus net debt divided by the starting EBITDA. And you would assume that as an exit multiple. And then you can go in and add scenarios to that. So this gives us our exit. This is how much money we made. This is how much we've sold the company for. Although once we sold, even though that's how much we've sold the company for, that's not exactly how much money we've made. Why? What's missing? Final debt. We need to pay down the debt of the business on exit. This is not the money that we've gotten. This is our exit. We have debt on the business. We have to be responsible for the debt because this is an EBITDA metric. This is an enterprise value metric, so we need to be responsible for the debt. Subtract out the net debt, then we have our return value. But the problem is, we know how much debt we've raised. How do we know how much debt we've ended up with? What's changed about the debt year after year? Paid it down and interest. Interest is incurred. So you need to pay down debt and interest. So you have to calculate final debt. The first thing you want to do is calculate interest, total interest. Total interest is the starting debt, right, from here, times the interest rate, times 1 minus tax rate, interest is tax deductible, times number of years. Interest incurred each year. That's the interest each year. Starting debt times the interest rate times 1 minus tax rate times number of years. Total interest. Then I say, all right, well, my total obligations that I have to pay down is total interest plus the beginning debt. And that's what I owe. That's what I got to pay for. I got to pay for the debt plus the interest incurred. So then I got to determine how much cash I've generated that can pay down those total obligations, right? You got it? Kind of? No, I don't got it. So first, once you know what you're paying for, then you say, all right, well, you know, I kind of back into this, right? So let me see how much I can sell the company for 5 years later. I sell it for EBITDA times a multiple. That's enterprise value. That's not how much money I'm keeping. I got to subtract out the final net debt to determine how much I'm keeping from that. So what's the final debt? Well, I know the debt I started with, but I don't know how that debt's changed 5 years later. Two things impact that debt. Interest is incurred and cash has been generated, so I pay down the debt. Two things happen. So how do I calculate interest incurred? Well, I take the beginning debt times the rate, tax deductible, 5 times. That's the interest incurred. Add that to the beginning debt. I am responsible to pay all that down. Now I got to figure out how much cash has been generated. How do I figure out how much cash has been generated? Well, a quick way is just to construct a simple unlevered free cash flow analysis. And this is why I left A blank. Even though this is the logical way I like to think about it, the first mechanical thing you should do is calculate unlevered free cash flow. Because if you calculate unlevered free cash flow, that gives you projected EBITDA, which you can use for your exit multiple, and that gives you cash. So even though I like to think about, well, first thing you do is to sell the company, the first actual mechanical step I recommend doing is just build out your unlevered free cash flow projections. That gives you EBITDA projections, that gives you cash projections. So you build EBITDA, depreciation, working capital, CapEx, just doing valuation, all that stuff. So the final debt equals total obligations minus sum of unlevered free cash flow. 5 years of that, right? That's all the cash generated. That's the final debt. That's the debt left over. And so D, the return, the money that we keep, is the exit, B, which is B, minus final debt, C. That's how much money we get. That's the way to do a quick LBO now. This is the way to think about it in an interview. And then the IRR, if you want to do IRR, is the return divided by what? What's not the purchase price? Equity. Equity put in to the power of 1 over the years minus 1. It's basically the Kager formula. That's it. That's the way to think about a leveraged buyout. All in the slides, all in the book. That's what I meant. Step B. So again, you get the purchase price, you get the uses and sources. Let's do a quick example up on the board. You first want to calculate unlevered free cash flow. That gives you a couple things. Gives you EBITDA that you can use for your exit. Gives you final cash. With EBITDA, we can calculate our exit. And to calculate final debt, we need to calculate a couple things. We need to know how much interest has been generated, how much cash has been generated. Right? Cash less the debt and the interest is the leftover debt. Exit minus leftover debt, that's a return. It's easy. It's that easy. Let's take an example. Let's say we want to buy a trucking company. I want to know how profitable it can be after 5 years in terms of equity investment. So I want to know, and I'll just forget the math, let's just do high level, right? I look at some key financials. I know if I want to determine the return, I just need enough key financials to build the unlevered free cash flow. So I note the EBIT, D&A, CapEx, change in working capital, taxes. There are no deferred taxes. Just like what you did at valuation, right? You don't discount the cash flows, right? Because the cash is coming in year to year. It's not a valuation. I also note some key balance sheet line items, which I'd utilize to determine value, to determine shareholders' equity is important for purchase price in this case. So what's important, the only things that I care about in terms of the unlevered free cash flow is the final EBITDA, 1611 plus 20. That's going to help me determine exit. And the cash generated. The cash generated will help me determine final debt. So let's say, okay, step one, I established the purchase price. And the way I did it, I know a little awkward. I did a 30% premium above the book value. That's just what I negotiated. 30% premium above book value, purchase price is $6,500. Let's just say that was given. I just want to get familiar with the process. So I established purchase price. Uses and sources. Well, purchase price plus the target net debt. Remember, I had noted the liabilities. Whoops. Oh, let's say this is all net debt, real simple. 6,500 plus 1,000 is 7,500 is aggregate value or enterprise value. That's my uses. Just purchase price plus net debt. Forget fees. Let's say I've negotiated 70% debt. I found a bunch of different lenders. Keep it simple for now. 70% debt. I'm putting in 30% equity. That's my uses and sources. Got it? Yes.
What's behind the 30%, 70% split?
Assumption. Just made it up to keep it simple. No, this is just a quick example. Yeah, got it.
If this is regarding enterprise value, doesn't that include net debt?
No, well, yeah, but this is based on shareholders' equity. Post-debt. The purchase price is based on shareholders' equity. If the purchase price is based on a multiple, then yes. Yeah, just random assumptions. Focus on the process. In reality, how do you determine debt and equity? We'll break that down in a more complicated example. Just want to illustrate the functionality of this. Okay, so what do I want to do? Well, first thing I want to do is determine my exit. So in order to determine exit, assuming no multiple expansion, I want to get my purchase multiple. Purchase multiple, real simple. Purchase price plus debt, 7,500 divided by the EBITDA, which was 1020. 7,500 divided by 1020 came to about 7.4 times EBITDA multiple. So I'm going to use that multiple. 7.4 times my exit EBITDA of 1631 is what? Who could do that real quick? 7.4 times 1611 plus 20, 1631 is what? 7.4 times 1631 is 1206.94. That's my exit. But that's not the money I get, because I need to first figure out my final debt. So I calculated interest first. I calculated interest, and I assumed that there was a blended rate of 9%. So I took 9% times the debt raised, which is 5250, times 1 minus tax rate, times 5 years. I'm assuming 5-year model. That's 1536 in interest. So I got debt of 5250, beginning debt, 5250, plus interest rate, which is 9% times 1 minus 35%, times 5 years. And that gave me, was it 35%? Was it 40%? Doesn't say. I believe it was 35%. 1536. Okay. Total obligations is the interest, 1536, plus the beginning debt, 5250. I owe that much that I will use cash to pay down. How do I know how much cash I've generated? I add year 1 plus year 2, year 3, year 4, year 5 cash. That's how much cash I've generated. That's come to, it's done here somewhere, 3215. Sum of the unlevered free cash flow is 3215. So I use that to pay the interest and pay the beginning debt, to pay down as much as I can. That gives me 3570. Final debt is 3570. That's the beginning debt plus the interest minus as much cash I can pay down. That's the final debt. So now I got my exit, 1206.94. I was able to pay down 3570. And that gave me about 8272. Why is it 11842? Must be rounding. And that's 7.4. 7.4. 1631. It must be like 7.36 or something like that in the model. But okay, so you get the idea. So this minus 35 gives you, in this case it was 8.2. It's probably, in this case it's probably like 9.3. That gives you an exit value. Exit minus final debt, 8272. That's how much money we get. Compare that with the equity we put in. So 8272 divided by the equity we put in. How much money do we put into the business? $22.50. That's how much we put in. To the power of 1/5 minus 1. Gives you 29.7%. That's the IRR. We'll do a lot more of these. You can kind of review this to look at generally how it works. What are the drivers? What are the major variables here? Oh, there it is. What are the key variables? The cash being produced, absolutely, is a variable. And everything supporting the cash buildup, right? EBITDA growth, CapEx, depreciation, useful life, anything like that. What else? So cash buildup, yes, you were saying. How much debt you're raising, big variable. What else about the debt that you're raising? Synergies might go into your EBITDA buildup, yeah. Interest on the debt. What else? Exit multiple. Big variable. Yes, Robert. Number of years. Timeline. Real important. We'll dig deeper and deeper into this as we know. The price paid, purchase premium, so entry multiple, purchase premium, right? The debt equity sources, how much debt you've raised, the interest rate, like you mentioned. Exit multiple, time frame, and then the growth, really everything relates to the cash. Those are the major variables. So let's go tomorrow. I want to dig deeper into the subjective, give a bunch of examples, work on the technical, and start to slowly get you comfortable with buyouts.